Good morning, everyone. I'd like to, on behalf of President Akinwumi Adesina, welcome you to this thematic knowledge event. For those with us in the room and those joining us virtually all across the world. This thematic knowledge event is looking at the findings of the second chapter of the African Economic Outlook report for the year 2025 on making Africa's capital work better for Africa's development. And we launched the report 2 days ago here in this room. So I'd encourage you to get copies of the report, which will be provided in this room for you to look at the details of what we are going to be discussing today. This particular knowledge event will focus on leveraging Africa's capital for development amidst increased development and economic challenges. We know we are living in a world where uncertainty is almost now the rule of the game. We are seeing a lot of multipolarization in global economic governance. We are seeing challenges in trade and trade policies. We are seeing challenges with debt and access to capital. We are seeing challenges with increasing costs of capital for Africa. But Africa has huge resources in all forms of capital, be it human capital, natural capital, fiscal capital, business capital, but also finance. Africa has huge opportunities to leverage these in order to be able to drive development on the continent. So this particular thematic event will allow us to dig deeper on what Africa can do in order to be able to leverage its own capital in the midst of the changing global environment that we are all witnessing. And to help moderate that event will be no other than the innovative, smart, intelligent, one of the best finance vice presidents that I've seen in the world, leading innovations for all the MDBs on how to actually leverage capital. So why not call you to the stage, Vice President Hassatu Nsele, the Vice President for Finance and the CFO for the African Development Bank Group. Thank you.
Thank you very much. Please do not believe him. Good morning to all of you. It's a pleasure to see you, and apologies that we are starting a bit late. And again, welcome to this knowledge event. Looking forward to this conversation with a very distinguished and expert panel. So I'm very delighted to have with me today the panelists that are going to share their experience in light of the huge financing gaps that the African continent is experiencing. And this requires solution to promote the economic and social progress of the African continent, while also identifying key challenges and opportunities. So let me welcome Dr. Denis Denia. If you can please come to the stage. Mrs. Abena Amoa. Dr. Razia Khan, she's online. And Mr. Chika Mordi. Monsieur Diouf, pardon. Monsieur Ibrahima Diouf. Good morning. Good morning to you. Good morning. Do you hear me? Ça marche pas? Le micro ne marche pas? Can you have the mic on, please? Hello? Okay. Hello? Okay, thank you very much. So maybe I'll ask, our panelists to introduce quickly themselves. Maybe I'll ask with Mr. Diouf here.
My name is Ibrahima Diouf. I'm the special advisor to the president of VoD, West African Development Bank.
Good morning. My name is Dennis Denya. I'm the Senior Executive Vice President for the African Export-Import Bank Group.
Good morning, everyone. My name is Abna Moa. I'm the CEO of the Ghana Stock Exchange.
Good morning, all. My name is Chika Modi. I'm chairperson, I should say, of United Capital.
Thank you. Thank you very much. And maybe let me start. Dr. Razia Khan, please. If you can introduce yourself. We cannot
Least at Standard Chartered. A pleasure to be with you this morning.
Razia, we didn't get the first part. Could you please go on again?
Razia Khan, Head of Research, Africa and the Middle East at Standard Chartered.
Thank you, and thank you very much all for being here with you. So maybe let me start with Dr. Denis Dinaya. So in light of rising global trade tensions, declining aid, and heightened volatility in capital markets, how is the Afrexim Bank adapting its trade finance and countercyclical lending instruments to help African countries mitigate external shocks and preserve access to affordable capital?
No, thank you for that question. But let me begin by giving you the context of Afrexim Bank's own creation. If you recall, Afrexim Bank was conceived in the late 1980s in response to the South American debt crisis. So when the African Development Bank and Ministers of Finance saw the declining availability of trade finance on the continent, they formed Afrexim Bank and we started operations in 1993. So our own creation was a response to crisis. And so responsiveness to crisis is in our DNA. So if you look at the last 10 years, we have faced three major crises. Firstly, 2015 to 2017, the commodity price shock. Afrexim Bank responded to this crisis by providing a 10 billion counter-cyclical trade liquidity facility, which enabled member countries to respond to the reduction in foreign currency inflows, mitigating the potential to not honor their trade obligations. We then had the COVID-19 pandemic. Afrexim Bank responded significantly, not only in terms of procuring the vaccines, but in terms of engaging the continent so as to procure the medicines, the protective equipment. We provided 2 billion guarantee to enable Johnson & Johnson to give priority to African countries in terms of vaccines. So we have been responsive. When the Russian-Ukraine crisis happened, we provided a response, which is the Ukraine mitigating facility. $10 billion was put on the table. We have continued to expand the bank itself by providing additional activities. For example, we have launched the Fund for Export Development to complement the debt that the bank provides. The Fund for Export Development provides equity which will enable African countries and African entrepreneurs to establish export-oriented entities and will generate more foreign currency. In terms of actual products, we launched a central bank deposit program to raise money so that African resources work for the development of Africa. From $14 million in 2014, we have raised over $34 billion from African resources, from African central banks, to deploy for African development and respond well to crisis. In 2023, our shareholders agreed to institute a concessional window. They themselves provided $200 million as seed capital. So this concessional window will help in crisis response and also in terms of financing SMEs. So we have diversified the sources of our funding. away from the Euro markets. Last year, we raised money in the Japanese market, in the Japanese capital markets. This year, we raised money in the Chinese capital markets. So that helps in us not depending on one source of liquidity, therefore in enhancing our response preparedness.
Thank you very much. Ms. Abena Amwa, the current global context marked by growing threats to multilateralism underscores the importance of developing robust local financial markets. So based on your experience, what decisive steps can African countries take to build dynamic, deep, and liquid financial markets that support the mobilization of financing for economic transformation?
Thank you very much. And let me give a warning. I'm here to speak on behalf of all of Africa's capital markets and securities exchanges, especially as I'm surrounded by bankers on this platform. As we all know, or we hear the rhetoric that capital markets are central to economic development, channeling domestic savings, partnering with international capital towards investments in the private sector, in the infrastructure, and other sectors that will fuel capital markets or wealth creation is very, very important. But listening to many of the things that have happened, you will see that Africa's development has been a lot driven by the government institutions, and capital markets haven't been at the center of our economic development. And that's what all of us at the African Securities Exchanges Association are looking to change. When my colleague talked, he talked about raising capital in Asian markets, etc. What are we doing about creating opportunities for Africa's retail investors, our corporate investors, to participate in the development of Africa's economies? And so I would like to, sometimes we say there's no money in Africa. Is that really true? We have pension funds that just in West Africa, between Ghana and Nigeria, almost 40 billion US dollars of pension funds that every day say they don't have investment opportunities and are parking over 90% of their assets under management in government securities, which largely go and pay salaries and do very little investments in the real sector. What are we doing in the pension funds industry? We say the retail investors don't have money. Some statistics I just looked at. In 2024, Africans invested 125 billion US dollars in cryptocurrency assets. 125 billion US dollars, mostly by individuals. Nigeria is the second largest cryptocurrency investor base in Africa. Over 65 billion went from Nigeria, only second to India. Where did all that money go? Outside of the continent. And we talk about capital gaps. And our development finance institutions are issuing bonds outside of Africa. So it's time for us, and the topic is very important, it's time for us to see how we co-invest with African institutions, create products, educate the retail investors, and channel all of these onto our securities exchanges. There are over 30 securities exchanges with limited products, mostly led by South Africa, and there's the need to develop more of these. How should we go about it? I think first and foremost, we must champion national as well as regional savings and investment plans or strategies. The EU has just launched theirs in March this year, the Strategy Savings and Investments Union of the European Union, where they are looking at how we get retail investors to co-invest with the pensions and institutional investors in selected key sectors, even including defense, SMEs, etc. And so for me, the message today is that contrary to the way we've approached our economic development, it's time for all of us to focus domestically. Because when the money runs away, when USAID runs away, when European funding runs away, we must look at who can we use to create the wealth that Africa needs. And I dare say that our SMEs, our infrastructure gaps, there is money in Africa today. And with smart policies, which I'd like to talk about in my second further on, we can come up with a structure that helps Africans benefit from the wealth creation that we provide other economies. Thank you.
Thank you. Thank you very much. And I'm sure you know that the African Development Bank has been involved in conducting security exchanges on the in the continent, and it's a work that is ongoing. So let me now turn to Dr. Razia Khan. So despite the growing number of private banks in Africa, access to finance remains a major challenge in general, and in particular for women and young entrepreneurs. So what needs to be done in order to unlock long-term and affordable private financing for women and youth-led enterprises?
Thank you, Vice President. There are two main parts to this. I think many of the panelists have touched on the current global economic situation, the volatility that we currently see in US Treasury markets means that Africa as a whole is likely to see a period of considerable uncertainty when it comes to broad capital flows. The funding costs for a lot of the institutions from the outside that would normally be thinking of African opportunities have certainly risen. But there is a whole other part to that, as my fellow panelists have touched on, and that is the capital mobilized within Africa itself. Why is it that we see these restrictions to access to financing for key constituents who could really do with the boost to boost their overall economic opportunities? Now, decade after decade, we've had various discussions on this. The depth of financial intermediation in Africa, the cost of providing these services, the regulatory environment. Are things changing? There's been reference to the adoption of digital currencies, and one would think that in this environment that broadly fosters the take-up of greater, newer technologies, we should be seeing a sweeping change in access to finance for the previously excluded. But the fact is that this doesn't seem to be happening, it isn't underway, and this certainly needs closer examination. The traditional arguments given were a range of macroeconomic instability, very high interest rates, a significant amount of risk aversion on the part of lenders. They were only ever going to be lending to those customers that were seen as the safest bets, and there was really very little risk taking, let alone maturity transformation. So not only were Africa's corporates somewhat disadvantaged by this, the absence of any longer term financing, but certain demographic groups may have found themselves significantly cut off from any meaningful access to financing. What needs to change? The more we see regulatory attention devoted to this, so central banks, apart from doing their roles as helping to bring about price stability and over time lower interest rates because there are no alternatives to that, perhaps also looking at some of the regulatory bottlenecks, some of the regulatory hurdles that have prevented this access to financing from becoming that much more widespread. Increasingly, if there are seen to be profitable lending opportunities, one would think that financial institutions, especially looking to deploy cheaper means of mobilizing capital, going digital, going mass market, would look to exploit this. And is it an issue of the regulatory environment that is impeding this access to financing? Is it an issue that when financial institutions do find profitable ways to lend, a negative spotlight falls on those institutions and the regulatory backdrop doesn't necessarily help? There are many issues, and we could probably spend quite some time looking at this particular topic of access to financing. But suffice it to say that if the building blocks are in place, if we see a certain amount of macroeconomic stability, if we are in an interest rate environment, and there are a number of economies in the region now where inflation is expected to moderate from previously very high levels, then the expectation is that with more regulatory focus on this segment, with more questioning why are some still cut off from financing, perhaps more can be done to address this. But I think to answer the overall question, it's been a function of macroeconomic instability, high and volatile interest rates, the cost of mobilizing deposits, and the rewards not necessarily being in place because of the negative regulatory attention that might be attracted for institutions that are intent on lending to these supposedly, or the perception has been, riskier segments.
Yes, couldn't agree with you more, Arazia. So on that, with that context, maybe let me turn to Ibrahim Adjouf here. So, given the urgent need to unlock domestic capital in West Africa, how is the VoD supporting national efforts to formalize economies, expand regional value chains, and catalyze private sector investment?
Thank you very much, Vice President. I'll just, as my neighbor had done, just give a context also on VoD. For those who don't know VoD, we are the financial arm of the WAMU countries, the 8 countries, and basically we operate in those 8 countries, and that's where most of our investments go. And as I speak, we're the first investor in that region, and we do invest about 1.5 billion on a yearly basis in that region. And the recent exercise we've gone through in terms of increasing our capital base and moving from 1.5 to 3 billion will give us more capacity. I think we should have had this discussion also 30 years ago. I mean, we've been talking about it for some years now, and I think that it's time we just collectively add our efforts and solve these issues. And if you look at Africa, I think one of the capital we have is the human one. The first one is human capital. And we always talk about how young is our population. But I think that we need to talk about also how creative this population is. About 60 years ago, we all, after graduation, wanted to be a civil servant. 20 years back, we all wanted to be in the private sector. And if you look at our kids, they all want to create their own companies. And I think we need to follow that trend. So human capital, we need to really look at that young population as an opportunity, not as a threat. If we don't do it, then it's going to be a threat. And it's becoming to be a threat in some of our countries. Africa also is the only continent where when we find minerals, we're scared. We say, a war is coming. Whenever we find something, we say, okay, we need to watch out. There will be some problems. So I think we also need to make sure that we work on the governance piece of it. How do we manage it, and how do we really negotiate with the international players? The last one I want to emphasize on is diaspora. And I think that we need to have that diaspora coming back and investing in Africa. And they're not doing it, or we're not fully utilized. But they can't do it if we ourselves are investing outside. I don't want to take the risk of asking, the public and ourselves to say where our savings are. Are they in Africa or are they somewhere else? I might not be one of those also who will not raise their hand. But I think that cultural shift needs to happen. This is where we need to invest. Africa is where we need to invest. And we've seen things, we talked about the global situation now and people pulling out. Should we just sit out there and just wait for something to happen? Or should we take accountability and make sure that we collectively invest in Africa for the development of Africa? I think that's the key question. Thank you.
Thank you very much. I mean, you did raise very important points here, and I would like also the other panelists to react at one point in time. But let me now turn to Chika Mordi. So Pan-African banks have expanded rapidly in recent years, yet banks lending in Africa remains slow compared to other regions. So in your view, how can Pan-African banks and commercial banks more generally shift their focus from short-term to long-term lending for transformational projects in Africa?
Thank you for your question. Let me follow the president of two of the other speakers by setting the context. So United Capital Group is a member of the Heirs Holdings Group. It's a quoted investment bank on the Nigerian Stock Exchange, and we're licensed to operate directly or indirectly in 10 countries in the sub-region. Heirs Holdings is the same group that owns UBA Bank, and they have something like 40,000 people employed across the continent. In response to your question, I think the starting point is if you think of banks, banks are rational actors, stating the obvious. And banks would pursue, they try to maximize returns and try to manage the risk in that process. This is important, and I'll explain why. The next thing is the idea of risk. So risk, which is born from uncertainty, increases over time. So we're pretty sure what would happen this afternoon. We're going to have lunch. We're not so sure what would happen next year or the year after that. And so the longer you go out in time, the higher the risk. And there's the expectation that with higher risk, you get higher returns. So unfortunately, this has not quite been the case with lending, when you bank lending within the continent. And the question then is, why do you have this disconnect? Because everyone agrees, there's consensus around the fact that long-term lending is beneficial for African countries. So the banks want it, regulators want it, governments want it, the public want it. But banks also have a responsibility fiduciary to their owners, to their depositors, because most of the money they have belongs to their shareholders. So first thing I would say is there's a bit of what I call a perverse incentive. So if you are in an economy like Nigeria, Ethiopia, Ghana, more of the non-francophone economies, as a large bank, your cost of funds are low single digit. So 1%, 2%, maybe even 3%. Now, the cost of risk-free instruments in those economies, government borrowing like treasury bills, are double digit. So in Ethiopia, 18%. In Kenya, it went down a bit at the beginning of this year, still high teens. In Nigeria, as high as 20%. So you make a very healthy spread lending the government by buying these instruments risk-free. So what is the incentive of lending long-term to the private sector that has higher risks if you're not going to get a commensurate return? So banks are being rational, and they're de-risking their portfolios by carrying liquid instruments that have a high return. Right. So now, are there bankable long-term projects? Of course, yes, there are. So why are the banks not doing as much as they could do, and what should they be doing? So the first thing is, if you think about it, if you have inflation at 30%, 25%, depending on what economy you're thinking of, 18%, then in preserving value, the companies are going to seek to have returns higher than that. And if you lend money as well, you want to get higher than that. Now, if I lend money at 40%, even for a bankable project, it would look very unattractive. But that might be the kind of return I require, right, on the long term, because we're trying to preserve value against depreciation of the currency and against inflation. So unfortunately, if we're using interest rates and a few fees, you're not going to get those returns. So the question then becomes what are the solutions, what can we do about this? The first is the courts of the government and the regulators. If you have a stable macroeconomic environment where inflation is low, where the exchange rate is stable, then lending long term will not be as perilous as it is. The second is if we have mechanisms where we could participate in the profit of these companies beyond the interest rates, then there is an incentive to do that. The third is the paucity of de-risking instruments. So if I want to carry a risk and I have products that could help me mitigate some of that risk, then there's an incentive to do that for long-term lending. I think this, I'll stop at this point, and I'm happy to speak a lot more. Do I have more time on that?
Yes, please go ahead.
Okay, great. So I think there also is the issue of the appropriateness of the type of finance, right? And there are sectoral issues. And what do I mean by this? So some sectors lend themselves to preserving value against exchange rate depreciation. So it's not a coincidence that when you see lending in, I use Nigeria because my native country, and if you were in an industry like the oil and gas industry where they generate foreign exchange, or you're in some elements of tourism, then lending in that sector is not as, the risk is lower from an exchange rate perspective, right? Because even if you lend in foreign currency, they're able to repay that because they can absorb the exchange risk because their pricing and returns are pretty much inelastic, right, to the exchange risk changes. Right, so one strategy is to do more of this, and it's not a coincidence that the largest projects you see in the region tend to be foreign currency funded, not just because of who's bringing the money, but even the domestic lenders lend in dollars. So if you think of the Dangote refinery in Nigeria or many of the other projects, they're still forex denominated lending because they're mitigating the exchange risk in those cases. And this is one strategy. The other obvious thing is that if governments begin to reduce the amount of their borrowing, if there's more fiscal restraint, and they're not crowding out the borrowing of the private sector, then that would lead to lower rate regimes and perhaps more stability in the long term.
Thank you very much for this perspective. And actually, I think that all our panelists have, brought a very interesting perspective to this discussion. And I really would like this to be a much more dynamic process. So maybe I will ask you to react to some of the comments you've heard here. Maybe I'll ask with Dennis anything that you want to comment on.
No, thank you, Madam Moderator. I just wanted to respond to my neighbor here. I think institutions are doing a lot in order to address the issues raised. The issue of youth unemployment, the issue of the creative sector. If you look at Afreximbank, we actually established a department to cater for the creative sector so that we can create employment on the continent. It covers fashion, film, writing, and this will create jobs on the continent. And we've also realized that we need to work together as African multilateral financial institutions. So Afreximbank spearheaded the formation of the Alliance of African Multilateral Institutions. So we come together and share risk, and we can do more. So we are doing a little bit to enhance that. Even for ourselves, we are putting in place mitigating factors to enable our capital to go further. We are copying from the ADB, they introduced the room to run, and we're also doing the same. We are enabling our financial institutions to lend by providing guarantees, risk participation. So we are trying to do our little bit.
Ms. Benamwa, do you want to?
Thank you very much. I think a number of interesting things has been said, but for me the key thing, and someone said this yesterday, debt capital or bank financing is to run a business, but to grow a business, equity capital has to be looked at. And we all know, at least from our schools, that there's an optimal mix of capital, which is equity and debt. In Ghana, the Ghana Stock Exchange runs both a fixed income market and an equity market. And what we've realized is that working with the local pension funds, we've been able to support corporates to access finance cheaper than their alternative financing options. I can give an example. We launched a commercial paper market last year. A commodities trader came to that market, raised 150-day paper at 17% versus the 27% they were paying their banks, with financing from the pension sector. Another institution came, issued 3-year paper at, again, almost a 700 bips difference between what they were getting from their banks versus what they were getting from the pension sector. So for me, it's developing the products and using our long-term savings and tools to finance the corporate sector. And we keep saying the private sector is our engine of growth. And yet, when you look around, there are so many state-owned enterprises that we say only governments can provide that service. We used to say that for telecoms a few years ago. I remember my family put in a 5-year application and we still couldn't get a landline. And we showed today that private investments has revolutionized our telecoms as well as our financial inclusion target. So my first call is that I think our governments are crowding out private investment, and we need to partner both. There is plenty room for our pensions and for our retail investors to invest in our economic sectors. And I love what my colleague said about it. Where are we investing our money? If we are not creating opportunities for all of us to invest in our housing sector, our creatives, our financial services, all that money will leave Africa and we'll keep talking about the same things. So put SOEs, all commercially minded SOEs, on the markets, the public markets. They are good for 2 things: access to capital, as well as better governance practices. Those better governance practices ensure sustainability and development here. 2, enable tech platforms. No one wants to walk into a stockbroker's office and open an account and all of that. Create AFDB, support the market, create Africa Invest platform. Let's put all the insurance, stocks, everything on one app that every African person can download, put in their national ID, and start trading across the markets. The securities exchanges are doing something under an African Exchanges Linkage Project, which will put over 2,000 companies on our securities exchanges on one platform and enable cross-border trading. Will the government allow us, through PAPs and other tools, allow easy settlement? We are hoping so that we can do cross-border listing. And I think that as we create more opportunities, retail investors, institutional investors will have more options, and companies can raise the capital that they need to fund the growth and wealth creation we're looking for. Thank you.
Thank you very much, Ms. Lamois. Dr. Razia Khan, would you want to come in?
I'm sorry, I didn't hear very much of the question.
Okay, so I just wanted you to react to some of the things that you've heard today from our panelists. Anything that you want to add?
So I think what really stands out is the opportunity in other African markets When we're talking about mobilizing financing in Africa or making financing work for Africa itself, one of the topics that usually goes unaddressed is just this issue of where the capital flows are going to come from. We know that the region as a whole has been disadvantaged by global shocks, and the impact of that global shock is always deepened as a consequence of what happens to the availability of financing, the availability of capital when the region is subject to those shocks. So we think back to the COVID crisis, an exit of a lot of investors, a flight to so-called safe havens, many African economies finding it very difficult to refinance their dollar obligations in international markets, and an inevitable wave of defaults that followed, simply reflecting those tighter financing conditions. We know that we're in a very volatile world today, and again, this is the risk. Not only do we see rising trade tensions, we'll have to see how these eventually settle, but the impact of all of this uncertainty has not been favorable for the region's commodity exports, but equally there's a focus on the financial channel through which African economies might be impacted. Once again, it becomes very difficult to issue in international capital markets. Access to much needed financing is that much more complicated. And I think the message here is that we really do need to be thinking of longer term solutions. Now, for many offshore portfolio investors, the opportunities in select African markets are still very significant. If you think of where a lot of those portfolio flows have headed in the recent past, Egypt because of the attractiveness of the yields and still the great attractiveness of the real yields, countries like Kenya that saw a significant currency appreciation. We've seen the Ghana cedi appreciating on the back of rising gold exports, and investors, not least investors from the rest of Africa, very, very tangentially involved in that. So I think if we're going to change the mindset that every time there is a global shock, it's inevitable that African countries, African markets will be impacted negatively, we do need to focus a lot more policymaker attention on how easy we are making it for African countries to seek their financing from other African countries. There's been, for good reason, a move towards greater regional integration when it comes to trade, the breaking down of those trade barriers. If anything, the presence of a whole new global shock so soon after the last shocks, after the COVID crisis, followed very quickly by the developed market inflation crisis, the rapidity of higher interest rate tightening, and the impact of that in Africa, we need to start thinking much more about the broad-based solutions available in this region itself. So just as we're talking regional integration, just as we're facilitating the availability of payments mechanisms that might ease the ability to pay for the exports of other African countries, African financial institutions, pension funds that are able to mobilize a great deal more savings should also be involved at looking at the opportunities that exist for investment in the region. Now, why doesn't it happen? When we talk about trade, we talk about the lack of complementarities, the fact that similar countries may be exporting the same thing. They don't really need to trade that much with each other. When we look at the likelihood that countries will be hit by financial shocks, perhaps what is impeding this intra-regional financial investment, the flow of capital between different African countries, is the perception that they will all be hit by the same external shock and all be negatively impacted in the same way. But if we start to measure the amount of financing that is mobilized from the region itself, if policymakers shift their attention to perhaps giving greater regulatory encouragement to that flow of capital into the rest of the region, maybe this can start to be the beginning of a whole new trend that over time creates greater resilience to these global shocks. No one is suggesting, given the nature of the shocks, that this is going to be immediate, that this will be easily done, but we could start by measuring it as a means to bringing about different outcomes.
Thank you very much, Razia. Thank you so much. So, Mr. Diouf, do you want to provide your perspective?
Yes, I just want to say a couple of words on access to financing, and it was mentioned. And obviously, it's an issue, and I think that we collectively have failed in dealing with that issue. And for sure, what we've been doing so far will not take us where we want to be. And I think that's where the development banks have a key role to play. You know, I've been a development banker for the past 5 years. I spent most of my life on the private sector, on doing commercial and investment banking. And one of the things when I was running a P&L, one of the first discussion I would have every morning was with my treasurer, how much have we made yesterday? And if you have that kind of mindset, you probably not going to be you're going to be looking at where you can make money versus where you can impact. Now, what, you know, my president tells me every morning is, if you cannot impact people, you're useless. If we cannot collectively impact the people, we're useless. And I think that under the leadership of AFDB, I think that's where we need to. I know we do a lot of things. We partner, all of the development banks partner. We get into other financial institutions, capital equity. We invest in equity, and we have lines of. But I think we need to do more, and we need to get to a level where we have a club, and look at this issue and say, let's solve it collectively. How can FDB, VoD, Afrexim, TDB, and the rest, these key, and Badea, you know, these key financial institutions can team up at their balance sheet and solve this issue. And I think that if I were to say something to AFDB, because you know we're hosted today by AFDB, I think it's your challenge today to make that happen.
And you know, at the AFDB, for each challenge, we have a solution. We'll get there. The last word, Mr. Morty, please.
Well, let me leave on a sort of optimistic note, and that's talking about the African diaspora. So you talked about human capital, and I think there's no doubt about it that Africa has incredible human capital. And the one way you could see that is to look at the diaspora and see, if you pick, for example, if you pick the United States and you look at Nigerians in the United States, they're by far more educated than the average person in America, by a factor of 27%, of more than 3 out of every 10 being graduates. They're wealthier in terms of the average income. They are more law-abiding. That would be a bit interesting because they have fewer, lower rates of being jailed or breaking laws and being convicted for that. And it's an important segment because you're seeing massive flows. Everyone knows about this. I'm not going to rehash that. But something in the magnitude of $28 billion is expected to flow to Nigeria this year from the diaspora. That is very significant. That dwarfs all receipts in bad years when it comes to oil. Now, we need to tap into that as we think about even the capital markets. And there is an initiative the central bank, which we're helping them work upon, has, but this should be something across the continent. And they'll be more disposed to longer-term investments within the country just because they're from the continent. Thank you.
Thank you so much. And ladies and gentlemen, a big round of applause for this excellent panel. Thank you very much. So, it does not work. Now it's working. So we now have a second panel. So we'll have soon on stage. May I ask people to sit down, please? May I ask the people in the back, please? If you can just take your seat. Thank you. So let me welcome to the stage Mr. Jan Lepalec, who is the president of S&P Global Ratings. Would like also to welcome Pape Amadou Sarr, who is the executive director, mobilisation, partnerships and communications of the Agence Française de Développement. Dr. Heike Hamgart, first managing director for Sub-Saharan Africa at the EBRD. And we don't have Mr. Rabah Ramani, right? Okay. So, Mr. President, and Massoud Adesse. Are you ready for the hot questions? So let me start with you. You know, the credit rating agencies, have been at the forefront of news lately in Africa. But let me ask you this question. So why is the cost of capital for countries so high? And what can be done to address this problem? How can credit rating agencies, in general, help address the financing challenges in Africa and facilitate the development of capital markets to ensure access to capital for necessary infrastructure and development spending? Well, it would be good to get your perspective. Please go ahead.
So first of all, thank you very much indeed for inviting me to represent S&P Global Ratings on this distinguished panel. This is an important topic, and actually we've got an important delegation here in the third row. Guys, if you could stand up, please, with our global head of sovereign ratings, all our senior analysts from multilateral lending institutions. I've been the president of S&P Global Ratings, formerly known as Standard & Poor's, for about 5 months. And I would like to thank the African Development Bank for giving me this opportunity, because as you can imagine, I've had to spend quite a lot of time thinking about the credit rating agency strategy for the next 5 years. And the previous panel, laid out all the key trends. So I'm going to give you the global perspective and tell you why this topic is so important. Point number one, this continent, Africa, is at the core of real economic development as we speak. For 25, our global economists forecast that average GDP growth in the world will be around 3%. The African continent will post 4.8. So this is where economic growth is happening here and now. And it's actually reflected by some of our rating actions on African sovereigns last year, where we had 11 positive rating actions. So I heard about volatility, unpredictability. I'm looking at hard facts, and the continent is getting out of the COVID-related issues, and in many, many areas is leapfrogging what is happening in other regions, particularly when it comes to energy transition. Energy transition hasn't been mentioned so far, and Africa is absolutely end-to-end at the core of that mega trend that is going and is reshaping entire economies, like in the Middle East and sectors. Why end-to-end? We talked about minerals previously. There's also renewable energies, the electrification of the economy, and ultimately being able to provide cheaper, more affordable services to the population. the needs and the investment needs for energy transition that will support economic growth through infrastructure and infrastructure mitigating climate investment, the need for funding is huge, and there is already capital that is ready to be mobilized to get there. So in the broader scheme of things, anyone who is betting on energy transition, infrastructure that is going to generate higher multiples has to look at Africa. So the question that is being asked today is fundamentally a question of financial plumbing. You've got pools of capital in Africa, outside of Africa. There's not a dearth of investment opportunities across the continent, but the plumbing is suboptimal. And it takes a village, and again, congratulations for the African Development Bank to be gathering that village on this panel and the previous panel. So it's getting the entire ecosystem to play their part, linking the investment community inside and outside of Africa with the investments that will produce economic growth and will help the continent be at the forefront of energy transition. How can we help? And it's not lost on me that a couple of years ago, credit rating agencies were perceived as distant, remote, hiding in their ivory tower, if I may, in this country. But I did realize that we had to be more present, we had to provide more transparency, and we had to explain the role we play. At the end of the day, what's our role? It's very simple. It's provide more transparency for investors so that they can make their decisions with conviction. We are one parameter, risk return is a very important one, and we help them assess the risk part of the equation. It's an important part, but it's not the totality of what drives investor decisions. And the way we do our work is by engaging with the issuers that we rate, with the investment community. And when it comes to sovereign rating, it's with multilateral institutions, the local institutions, obviously, and coming up with our rating opinions. And by the way, these are opinions but that are dictated by transparent, readily available methodologies. Sometimes I'm hearing that there's a need to regulate credit rating agencies. We are one of the most regulated financial industries in the world. In Africa, we actually operate according to 3 different standards that we're compliant at each single moment. That is US credit rating agencies regulation, European credit rating agencies regulation, and African credit rating agencies regulation. Why? Because we're accountable. Because what we do is not just dictating truth from somewhere, New York, London, Singapore, but it's really being accountable for the decisions we make that are credit ratings that reflect the combination of quantitative and qualitative factors that are applied according to a publicly available methodology. And fundamentally, what I keep telling the investment community and the issuers is that you've got to challenge us. And to challenge us, we've got to be more present. And that's what we're doing. And therefore, the reason why I asked my colleagues to introduce themselves and stand up. So our commitment is to be more present, so that you can challenge us. But we're one piece in that equation. Ultimately, decisions are made by the investment community according to their own investment horizons and their own risk parameters. But we want to be that cog in the machine that we know is important, and that's going to facilitate doing our job the best way we can by being more transparent, by being more engaging. Sometimes, and very often, one of the inherent parameters of our business is that issuers tend to disagree with our decisions. But that's healthy. And that's the way it should work. Because we don't hold the absolute truth, and we recognize, again, that by being challenged, that's how we can continue to improve and sharpen our opinions. So my commitment and the commitment of my team to Africa, if you will, is to be there, engage, provide more transparency, and be accountable. But what do we need in return? We need more data. I commend the GEMS initiative, but we need more. We need more disclosure linked to data, because our analysts, as credit analysts, tend to be conservative. And you've got to rely on historical statistics, track records. The teams need that. So the more we can get access to data points, the better. And that's the reason why we're mobilizing teams of experts to make sure that once we get access to the data, then that can lead to adapting the way we see things, including our rating definitions. I will give you an example. We realized that in the recent past, some sovereigns created instruments or used instruments that could trigger a deferral of coupon based on natural events. That didn't fit our rating definition. Our methodologies team thought long and hard, and in December, we made the decision to adapt our rating definition to take into account those instruments that under certain conditions will not trigger a default. I will give you another example. We're getting more data, which is great, on project finance. We published a request for comment on a new methodology a month ago for a more esoteric topic, which is CDOs, so collateralized debt obligations of project loans, that cover the majority of projects in emerging markets. And why are we doing that? Is because we can update some of our recovery parameters based on more access to better data sets. So as we engage more, as we get challenged, but in return, we get more data, we get more historical statistics, we will continue to adapt and make progress and do all of that together. One last point I want to make. Another reason why we are mobilizing some of our most senior people on those topics is that thanks partly to the multilateral organizations, and the African Development Bank is a great example, there is a great deal of financial innovation that is taking place. And that financial innovation is not straightforward. And it very often requires bringing together domain expertise from multilateral lending institutions, structured finance, public finance, and in certain cases, project finance. And kudos to the African Development Bank for challenging us on the Room to Run project that required bringing together all those experts. And I think the outcome was incredibly positive because it also helped us to think through something really innovative. Another case in point is after the African Development Banks, more multilateral lending institutions are issuing hybrid debt, which is a brand new asset class, and you need to be the first to start this. It takes a lot of innovation, but also resilience and ambition to do that. And now we see that asset class growing. So let's think about this in terms of the opportunity. Financial innovation is happening. It is there to support a better alignment between the funding, the investment community, the capital that is funding, and the projects. And I think we've got financial innovation, we've got great goodwill from all the participants, we're ready to get at the table. The multilateral lending institution will be doing a great work, and so I'm very optimistic. One last point, we talk about geopolitics, uncertainty, volatility. This is a world post-globalization that moves towards regionalization. And Africa is one of those regions that, for all the reasons that I referred to previously, is going to play a critical role. So it is a matter of capital flows across Africa, funding in Africa for African projects, make Africa great again.
Thank you. Thank you very much for this. So, to the question, why is the cost of capital for countries so high, and what can be done to address this problem? You need more data. You need more disclosure, more information, more engagement, countries to challenge you, and you're there to listen. So I think that this is a very clear message, to countries, and we're going to challenge you for hybrid capital. Your request for comment, we're challenging you on some of this. So, but thank you very much. I think this is a very important discussion, and maybe we'll talk a bit about the African Credit Rating Agency that the African Union has launched. So thank you very much for this, for sharing your insights on this. And so maybe let me now turn to President of TDB, if I can just get my notes. Sorry. Getting everything but that. President Atmasu. Just going back to my papers. So President Atmasu, so with, maybe you can tell us what the Trade Development Bank is doing in order to, to mobilize more capital. What you're doing and what you're planning to do to leverage capital better. Let me start there with you.
Thank you very much, Hassatu, Madam Moderator. Very happy also to be here on the panel with colleagues. The theme of these annual meetings is about mobilizing African capital. And of course, TDB Group is one of the very specialized African financial institutions that's built on African capital. Of course, we are mobilizers, we're multipliers, we're connectors, but we know that we're facing massive gaps in increasingly difficult circumstances. And so I think the previous panel, we had the very fine lady representing the stock exchanges who was saying, well, how can we create opportunities on the African continent for African institutional investors to come into investment opportunities that are risk-adjusted and attractive and balanced? So a few years ago, we said, let's move beyond business as usual. Let's try to set up new special purpose funds that are tailored to the risk appetite of institutional investors, starting with African institutional investors. And we weren't sure how far it would go. It was a little bit of an experiment. And in fact, to build confidence, we got a strategic partner from the UK that was quite specialized in doing this for European investors out of London. And so we did a joint venture, and we established a fund, and we were very surprised that within a couple of years, we moved from 10 to 20 African institutional investors. Today we have over 50. And we're moving towards $500 million in terms of the assets under management in that fund. And now we've learned from a number of other institutional investors who are sitting on the fence, didn't want to come in. They felt that our fund was too closely designed to a money market fund to finance trade assets, and they felt they needed longer term assets. So they said, well, if you bring us a fund that's a little bit longer in tenor, we might like it. And so we've just done a soft launch of our second fund. And the interesting thing is we did roadshows, we did market the fund quite wide and broad, but we were quite surprised that it was really heavily subscribed by African institutional investors out of our Mauritius platform, which is one of our headquarters as TDB Group. And so that is a case in point. And of course, we had to get some strong anchors in there. We have one very strong investor from the Gulf region, from Saudi Arabia, that has around a quarter, 25% stake in the fund. We put 25%. So from a volume perspective, we had two big anchor investors coming in to subscribe to half of the fund. The rest were quite small, relatively distributed across the rest of the 50%. So that's just a practical case of how we've done this. And this is the kind of fund that will help existing banks in the continent to actually de-risk, offload some of their concentrations to this fund that can then give them some headroom to go and do some more. And of course, the fund doesn't just originate, it does transactions in the secondary market space, and so a form of room to run, you know, another way of doing the same thing that was just described. And so that's just an example, and I think if we can continue to be disciplined, generate a healthy balance of risk and return over a period of time. We already have a 5-year track record. We're seeing very strong interest, and we're hoping that we can actually multiply this kind of growth going forward, soaking up African capital. We also are beginning to see interest from outside of Africa, particularly the Gulf region and also Asia. Like Afreximbank, we've seen the judiciousness of reaching into different money centers in order to complement what we already have by way of African capital. So we're very active in Japan, we're very active in China, and we've already been active in the GCC, the Gulf region, for quite some time. So there is a level of maturity that's coming through now into the African financial institution community, where we're beginning to understand the importance of diversifying access. But really, we still have a lot of work to do to realize the thrust of the theme of this annual meetings, which is, you know, these billions of dollars of African capital that are not yet working for Africa. How can we harness that better? We've made inroads. There's very good stories. Several of us have done it well. But I think there's also an ecosystem issue there that needs to be highlighted. It's not so much the rating side as much as it is the regulation side, and also the global financial architecture, right? Because there are big issues that are global that actually get in the way of inspiring confidence in African institutional investors. Because if they don't see the level ground or the playing field to be level, so to speak, they will run to safety. So this is where African policymakers and African stakeholders have an important role to ensure that the rules of the game are being observed for everybody. A classic case is trade finance, which is an asset class that I'm specialized in, like Afrex. And we do trade finance as our bread and butter business, and then when debt restructurings come in, all of a sudden you see that protected asset class being dragged into debt restructuring, but other banks are not being subjected to that. Internationally, it's not happening either, right? So internationally, there's consensus that trade finance is excluded from debt restructuring, but we're seeing letters of credit and those types of instruments being involved in those types of situations, which really acts to disincentivize the participation, not just of African financial institutions, even international commercial banks who are already feeling disincentivized because of very, very onerous compliance regulations coming globally. Again, a GFA issue. I was speaking to an international bank not long ago, one of the largest in the world, that said, we're now coming into Africa. That's good news. We have rep offices now in 4 or 5 different jurisdictions, and this is relatively new for us. And I said, well, congratulations. Thank you for doing the reverse of what most other international banks have been doing. And I said, so what's giving you confidence, and why are the others running away? And then the gentleman was very frank, and he says, well, look, you know, it's the point of growth that Standard & Poor's mentioned. He says, look, the future is not just the dividends of demographic growth, it's just a combination of that and economic growth, which makes it inevitable for us to want to have something here for my successor to be able to harvest. Even if I'm not able to do a whole lot to start with, I want to get the ball moving. But then, he said, all said and done, you have work to do together with your fellow Africans, because the regulations here are killing us. If we make one mistake in Africa, we get slapped with a $10 billion fine, right? And there's no amount of profitability that will actually offset that kind of punishment that you would get. Mistakes happen. We live in the real world. There's no perfection, right? So it's when regulations are so onerous that something little goes wrong, KYC or KYCC, something happens and then all of a sudden, you know, you're in the midst of a transaction that somehow slipped somewhere, and then you get heavily punished for that. These are the disincentives that are being created that's causing global banks to think twice and three times about providing correspondent banking services in Africa. And so we have a role to play. I think we are stepping in to fill some of those gaps. And we're very happy that the Standard Chartered of this world and others still see the wisdom of staying engaged and staying on the ground. JP Morgan, the largest US bank in the world, has now come to Africa in a significant way. So there are some good stories despite all of these disincentives. But really, it's just unfortunate that you should be an emerging market, a frontier market. You have enough challenges to deal with. But again, it's that ivory tower syndrome that my good friend here referred to. You know, it's not just the ratings agencies who need to demonstrate engagement and understanding and willingness to understand our ecosystem. I think others need to do that too. And so these are some of the challenges we face in terms of trying to mobilize capital. The global issues do filter into the continent. Africans are smart. If they see it a lot easier to just plug your money into London or elsewhere, you'll do that because your environment is subjected to a lot of unnecessary risk.
Thank you. Let me now turn to you, Papa Madusa. So in the context of announced aid cuts by several donor countries, including France, how is the AFD rethinking its development financing model to remain a reliable and impactful partner for African countries?
Thanks, Hassatu. Indeed, as you've noticed, we have been facing over the last few months some cuts in development aid budgets. You know, the main one coming from the U.S. France has also reduced for around 2 billion and 25. But I want to be clear that this has not affected us, our work, how we operate in Africa, which remains our priority at the French Development Agency. And first of all, we, on a yearly basis, engage around 12 billion euro, and 45 to 50% of those resources comes to Africa. And Africa is our priority region, first in infrastructure, urban development, sanitation, social development, healthcare and education, and things related to climate change. And we're very happy as well to work with the African Development Bank in terms of partnerships to work together. We work with your teams. I've seen Salomon here as well. And we have been, over the last 4 years, working together to deploy approximately $500 million on a yearly basis. From 21 to 24, we've been able to spend 1.6 billion euros together in co-financing programs across the continent. And this is in terms of sovereign operations. For non-sovereign operations as well, we've been able to do, on our behalf, almost 800 million euros just last year. That's to show, even if, as we were saying, in the context of aid budget cuts, Africa still remains a priority for us, because we believe in the potential of the continent, as Admas was saying, that and it is an ex-frontier for development. And the partnerships we do with you, we do it as well with the World Bank, which is our first partner, and we do around 4 billion a year. And what is important with our partnership with the World Bank, we are their first partner in terms of engagement and co-financing activities. And the work we do with the World Bank, we do with you, we do as well increasingly with emerging actors. Admas was talking about it. We are increasingly engaging countries in the Gulf countries, be it Qatar, the United Arab Emirates, Saudi Arabia, together as well with the Islamic Development Bank, which is very present on the continent, to see how we could multiply our resources to have more impact. What is also important is the private sector. We believe in the strong position of the private sector. So our branch, Propalco, which is our IFC, we used to say, is also very engaged on the continent, and Africa is its premier client on a daily basis. That to show one other aspect is the domestic resource mobilization. We deeply believe at the end of the day that Africa, it's in your report, should count on its own resources, increasing domestic resource mobilization. Our technical assistance branch called Expertise France work with governments in ministries of finance to raise taxes. I think you're going to come back to that later on, and help tax administrations collect more resources and better spend them in terms of impact to reach sectors such as infrastructure, education, and healthcare. We also, I think we've not mentioned a lot about it, but there's a lot of tax evasion, and there are a lot of illicit financial flows flying Africa to go abroad. And our work is also to help strengthen capacities and help African governments work together with administrations, civil society organizations to help fight those illicit financial flows that get out of the continent, which could be used appropriately to impact and have, how can I say, beneficially onto populations. And to conclude on this side, I want to say we've all seen what has happened with AID, MCC, and a lot of resources from US won't be coming on the continent. You have some of the European countries that also are reconsidering the budget. 26 will be tough as well, to be honest with you, and some of the countries will have to recenter on themselves. They have some populist parties coming to power in some European countries that are questioning the question of aid assistance to Africa, and does it need to benefit from companies? In our case in France, increasingly the private sector is saying, yes, we could do 2, 3, 4 billion euros to African countries, but we have to make sure that these resources goes to French companies. We're coming back to tight aid at some point. You know, the discussion are going at OECD, how to see, do we need to support French companies to build operations in infrastructure, energy, etc., to support Africa? Or do we need to do proper tenders and make sure that the best one wins? I'm not going to say about the big elephant in the room, China. There are questions about how we cooperate together, all together, US, Europe, with China on the continent. These are things that, you know, the African Development Bank can help, the African governments themselves can help, and see where are the chances, where are their priorities, and how they can mobilize enough resources on the continent, but also together with their partners. But we, as a French TFI, we stand aside the African Development Bank to meet those challenges.
Thank you very much, Papa Madou. I think that this will require, that this whole trend that we're seeing will require probably a change in the narrative, a change in the way that we communicate, because I think that we've been communicating on SDGs, on the impact on people, etc. But I think we will need to start evaluating, analyzing, and communicating on the return on donors. And actually, it's not because we're not talking about it that they don't exist. And maybe there may be some surprises. The number of jobs that this aid or investment is doing in Africa, how much jobs it's being generating in donor countries, the volume of exports. I think that there is a whole story to mine them, and maybe it will, it might change the dynamic. So looking forward to this. So let me turn to you, Heike. If you can tell us, leaning on your experience and the outcome of your partnerships in Africa, how can frontier technologies be utilized to elevate ethical finance and capital mobilization
and also help promote real economic value.
Thank you so much, and thanks for the invitation. I'm really incredibly happy to be here. It's a great moment for us as an institution because we just welcomed 3 new shareholders, Côte d'Ivoire, Benin, and Nigeria, to the EBRD, following sort of Egypt, Morocco, Tunisia that have been there for a while. And now sort of Kenya, Senegal, and Ghana are on the verge of becoming shareholders in countries of operation. So we're incredibly happy to, expanding to that part of the world and sort of also sharing some of the lessons we have from North Africa, but also learning a lot from the continent. And I thought a lot about how I wanted to present sort of, what we think we could bring with partnerships to the continent. And so, apologies, I'm German, I like football, but then I'm also here in Côte d'Ivoire, which just won the Africa Cup of Nations. So allow me to explain, I think, how we can do these ethical, impactful investments with a football metaphor. So I really believe that, the ones we want to support are the strikers, which are the ones that will hit the goal. So how do a winning team? And the strikers, these are the private entrepreneurs. These are the African private entrepreneurs that are at the front line facing, the challenges. And so what can we do? All of us sitting here. So we are, I think, the midfielders. So we make sure sort of there's a flow in the game. We bring the sort of the money so that things get moving forward, that really the private sector can sort of do what they best at, innovate and shoot goals. And I think sometimes we do short passes like trade finance, so it's really important. Sometimes we do the really long ones from the back, so that really take a lot of emphasis. Sometimes I think, we need our sort of defenders, which are like the insurers, the climate, all the sort of people that really make sure we don't take too much risk. We also still need central banks. I mean, the goalkeeper, last resort, we really, without a goalkeeper, it's gonna be really bad. And then, of course, we need the rules of the game. I mean, we need the referees, the rules of the game, and this is the great role, of course, that governments have to play. That governments and the judicial system, they have to make sure. But actually, I mean, who has not been like mega annoyed if the referee would try to shoot a goal, or if the referee would, tackle one of the, strikers? And this is exactly what the CEO of Ghana said. There's too much public sector doing other things than what they're really good at. So, really we want to see also great referees, great rules of the game. So not too much debate about the offside, let's go forward. And then, okay, I see the rating agencies, you have a role, you commentating on everything, honestly. How we understand who actually plays well without you, So you sit there, you commentate, you help us understand, was that a good pass? Did we really work together? Did we shoot to each other, on the development finance world and enable the strikers? So you will tell us, ooh, did this physiotherapist really help striker number 1 to be optimized, the speed? And so this is a super important role, but we also don't want you to kick the ball, I mean, we want you to really comment on the game. So I think to create a winning team, we really need all of us, but we all need all of us to be at our best, to really work together, because ultimately we think this continent really has the best strikers on the planet. We heard this on the previous panel. They have really the strikers that can come up with innovation that have not been anywhere else, and they can teach the rest of the world, but without receiving the ball with the right speed, with the right velocity, with the right rules, they will not strike a lot of goals. So I think, there's huge, huge, huge opportunities, and I just hope that we will all together create this winning team so that the continent will really strike the maximum number of goals. Thank you very much.
Bravo. So, I don't want, maybe if any one of you wants to comment on, what you've heard today and provide your perspective. And maybe if you also want to discuss, take the angle, for example, ODA declining, the rising cost of capital. So how can, African countries reshape their development financing? Our strategies to reduce the dependency and build greater fiscal reliance. I don't know who wants to maybe take that question.
Just maybe 1 or 2 inputs into that perspective. TDB, of course, being a trade-orientated financial institution, is somewhat used to having to work with counterparts around the world who require some level of tied arrangements. So I think my colleague talked about companies from a particular jurisdiction needing to benefit from certain monies that they may be using. Well, you know, the ECA world is very clear about that, and we actually are intermediaries for quite a few ECAs. And our view is that in this world where things are becoming so self-centered and nationalistic from an economics perspective and trade perspective, I think as Africans we should be able to do what many people in the first world do, which is basically pack 10 credit cards in your wallet and basically go around the world and be able to use the credit from 10 different companies for suppliers and contractors from 10 different countries. And so that's another way of bringing competition into the mix, my brother, because you said let the best entity win, right, in terms of providing a solution. So if you have multiple sources of funding, those funding sources can be matched to contractors or suppliers who have a good value proposition. And all the big countries that are big exporters and big manufacturers have a lot of ECA money that's almost unlimited. And I think for me, what I find interesting in this whole new era we're in is, you know, we for instance have a relationship with an ECA in one of the largest economies out in the US, and we've struggled to use that credit line because there's just not enough trade happening, even though AGOA's there and we've all been very enamored with the spirit of AGOA, but when you look at the actual numbers, there's just not a lot of trade happening. So this new development is actually almost a wake-up call even to the suppliers on that end who might find more innovative ways of doing business with Africa, maybe sharpening and enhancing the incentives, but more than that, taking a little bit more risk, because sometimes, you know, it may be better to set up foreign direct investments on the other side so that your investments can now also pull the products from where you came from. And I think that's a big problem we have in the continent. There's just not enough risk capital. Everybody wants to trade and sell with Africa, but there's just not enough, you know, investment here in real terms. That's not just providing the jobs, but that's also in a position to attract the equipment and the supplies that others want to put to us. And so maybe this new era will perhaps you know, create a little bit more impetus for you know, those countries to come in and settle on the ground. You know, one thing that really I found interesting a few years ago is the world of PPPs is a fascinating one, because it's not something that has been very how can I say, popular or well tested amongst investors coming from the eastern part of the world. It's usually something that you find very well established and well practiced in sort of, you know, market economies that have had that concept for a long time. And I remember when the debt sustainability issue was really beginning to get very sensitive, there's a lot of diversion from sovereign debt to PPPs to sort of use that method of contracting and procurement and sort of borrowing off balance sheet. And in Nairobi, we were working on several PPPs, and it was fascinating to see that the least likely part of the world came in and actually closed the PPP, not just closed the transaction, built an expressway in a matter of 3 years, has captured the imagination of everybody. And so now, you know, we sort of look at PPPs, and it's not just, you know, it's not coming from the usual areas where you would expect it to come from. The unlikely PPP players are coming in, putting in risk appetite behind that, and actually demonstrating very interesting assets that are solving big problems. So in Nairobi, we have a traffic issue. You know, it used to take sometimes 2 hours to get from the city center to the airport. Now it takes 15 minutes due to an expressway that was built on PPP terms, and it was not the type of counterpart you would expect to do a PPP. It was the kind of counterpart who would historically do a G2G arrangement. And it's just interesting, you know, and when you unravel it all, it comes down to risk appetite, right? Because there's other PPPs that have been under negotiation for years, and they've not moved. It's not moved, why? Because when you get down to it, everybody wants to be able to put the risk back to the sovereign. You know, so a PPP is supposed to be a division of risk labor, you know, and that part just seems to be very difficult for some to sort of digest. So I think in the end, we're back to that conversation of risk appetite, and I think this is something that, you know, the rest of the world has to sort of deal with at some point. The returns are so high in Africa, you should take a little bit of risk. Why should you get so many returns if you're not taking risk?
Thank you for that perspective. So, anyone, Jan Lebel, do you want to react to this conversation and what the other speakers have?
Yes, thank you. You touched upon the topic of the African Credit Rating Agency. I think this is a very important one. What we do, our business is global ratings. So the calibration is global, and it caters to primarily investors based in countries like the US, Western Europe, Japan, typically, that manage their portfolios around the world and want, you know, a global benchmark to make their investments. There's a need for national ratings. What's the difference? It's very simple. The global rating caters to global investors that invest globally and want one global benchmark. The national ratings cater to the national institutional investors. And as a result, the way they are calibrated is that there's the proverbial rating scale that goes up to AAA. In a national scale rating, your own sovereign is the AAA. And then all the credit risk gets calibrated from that ceiling downwards. And particularly for the corporate sector, that creates a rating scale that is much more granular and captures the difference in credit risk in a much better fashion at the national level. Why does that matter? It matters because, as we heard before eloquently in the previous panel, in terms of both financial stability, the sustainability of the plumbing and the financial infrastructure, you have three dimensions that have to walk hand in hand. You've got the banking system that provides the funding. You've got the public markets, and we heard it loud and clear about stock exchanges in the previous panel. And the third one that was mentioned in the previous panel as well is the pension funds, the life insurers, more specifically the annuity insurers, that increasingly have an ability to invest directly and mobilize their balance sheet from long-term investments outside of the banking system, and for some of those investments outside of public markets. And in the youngest continent in the world, the topic of retirement and saving money is going to mobilize big sources of long-term capital that don't need a high level of liquidity instantly. So those pension funds, those annuity insurers are going to be that pool of capital that is going to drive stable long-term funding for the African economies. What is it that they need? A national rating. The global rating is far less relevant in that case. So I really welcome the creation of the African Credit Rating Agency, because I believe that it is providing that type of solution that the market wants. And number two, as I always tell my teams, I love competition. They keep us honest, they keep us on our toes. As my neighbor said, let the best win. That's the way it works.
Working together. Thank you.
Maybe to come in on the national credit rating and the theme of the risk appetite, I think maybe one element that I wanted to highlight is also we need to see what risks are really pertinent. And I think one risk we can significantly reduce is the foreign currency risk. And I think I just want to make a short pitch to trying to be more able to lend in local currency. Sort of a challenge to all of us, but a challenge also sort of to the market, because I think the foreign currency risk is a risk that sort of you don't get often the right return for it, and also that will really disencourage sort of long-term investments if you have very volatile currency environments. So I think one area where we also hope to bring something new to the continent and want to commit as a global development bank to really, as often as we can, focus on local currency solutions. And sometimes these are only short-term, and sometimes we can find long-term hedges, and sometimes you have only then variable rates. And I was just sharing before the panel some experiences. So we have very competitive rates when we swap with Egyptian banks. And in Tunisia, we didn't get very competitive rates, so no one wants it. So it's also a learning curve, and it's not something that works in every country. And I think different institutions can play important roles in enabling it. But I think this is also an area where we can all collectively reduce the risk for investors to invest and have more local currency availability in all maturities on the continent.
Not fully agree, and I think that I've been at the African Development Bank for quite some time, and I remember when I joined, when we were talking about local currency capital markets as a solution for debt issues, it was but this is a long-term issue, and that was like 27 years ago. So I mean, like some of these conversations, they're the same. You come to the annual meetings, this one, the IMF World Bank, we all talk about the same things years and years again. Domestic resource mobilization, we need to do it at scale. That is the answers for development. Local currency capital markets, sovereigns in order to shield against, debt sustainability issues, FX currencies, local currency capital markets. But we're not there yet. So, and I think that the role of the African Development Bank and the role of MDBs is also to support the countries toward this path. But there are real solutions, and unfortunately there are too many short passes. I don't know, I'm not a big fan of football, but I just love what you said. But like too many short passes when you can just hit the goal, okay? So, voilà. So instead of, just go there, you just go here, there, and maybe you'll get there. So, but let me give the last word to you, Papa Madusa.
Yeah, I mean, I will focus a couple of things. The first one is domestic resource mobilization, because I totally believe in it as a Senegalese former official of government and working now for France. And I realize, and then having been governor here for 3 years, that we talking about the same thing all the time, and there needs to be action to score goals quicker and stop competing against each other. Sometimes it creates some troubles between the multilateral development banks. And one of the key things today I believe we can help governments in is to foster domestic resource mobilizations and interconnecting the different administrations, because where we have problems is between the tax offices, the customs, and the revenue authorities. Sometimes there's not enough communication, and a lot of losses of resources voluntarily or involuntarily, and connecting those with digitalizing the processes, bringing in fintech companies to help build strong information systems will help have more resources, increase the tax base, and also make sure people pay the taxes at the right moment. The informal sector, this is something we're working on a lot at AFDA, and together with the African Development Bank, we have a program called Choose Africa and Youth Entrepreneurship Investment Bank. I've seen Solomon here, where we're supporting young African entrepreneurs and female entrepreneurs to have access to funding. Because, all the big bankers that are here at some point, they do not lend enough resources to people that need 10 million CFA, 5 million CFA or less, which is more than 70% of the African economic basis. So if we don't tackle those important segments of the population, giving them access to credit, to guarantee, to technical assistance, making sure they grow, and over 3-5 years, they become taxpayers, and to enlarge the tax base, becoming 40-30% tax to GDP ratio, which is today around 10 or even 6% in some countries, we will not get there because we will still be addressing a niche and some key private sector companies, you know, that the IFC or Proparco or others will be lending EBRD resources to. So we really need to take into account the general mass, how we make sure that in the next 5-10 years, we encompass more businesses, we support more private sector, because I do believe governments alone will not have the capacity to lend money, because at some point they will hit some limits with us, with you, with everyone, because of the debt to GDP ratio. So at some point we have to help the private sector strive, we have to help the informal sector get out of the informality and get more formalized and paying taxes and developing the continent. Because I totally believe in it. As an African, our development have to happen here, and the others will come help us. If not, as you were saying, at some point, be it Dutch, be it French, be it German, they would all the time put on the table the question of, I'm giving you 2 billion euros, what's in it for our companies, what's in it for us?
Thank you very much. So I don't think there is white smoke yet. So maybe last words. Yeah.
Last words. No, I think it's really about, I think all of these topics, some of them we've been talking for a very long time, but it is really sort of, I think looking at the innovation that we all have and pooling these innovative resources on the continent together. And I think we've all have discussed a little bit also the role that technology can play in enabling and fast-tracking a lot of the topics that we have. So I think utilizing all the role of technology and fintech in particular on this continent could also really enable us to work better together and to make sure that we have a more efficient and will together create a winning team.
My concluding remark is we should all continue to press innovations and reforms. Africans have a role to play, but so does the rest of the world, and I hope we can all concert efforts to get some more serious results there. Thank you.
Innovation is happening in Africa. From my perspective, over the past 2 to 3 years, there's been a sea change, and from my perspective, the most important point, I represent a credit rating agency, we rate debt. But as was said on the previous panel, there's a need for equity. Innovation is funded through equity. There's a need for more equity investors because they will just do that. Continue to support technology and financial innovation in Africa. And I really take comfort from the fact that over the past 2 to 3 years, Mauritius has really come up as the gateway into Africa, particularly from an equity fund perspective, and that is very, very encouraging, and there should be more places like Mauritius.
I will continue the same lens in that innovation is key in terms of products. You know, Jan was mentioning equity, but also guarantees is more needed to be able to have a leverage effect, but also, from my perspective, the collaboration part is essential. We cannot, you know, play separately. We have to play all together with the same goals of impacting the development of the continent and not compete between development, climate change, and other issues, because you tend to have those issues also on the table when you have to prioritize those topics. And as you were talking about the white smoke, and to pay tribute to a man, a friend of France, and our CEO and myself, President Adesina, who has been a key partner to us, and I've seen the tribute to him a couple of days ago. And, you know, knowing him personally, I've seen how, you know, important he has fostered collaboration, partnership with us everywhere he goes. to bring Africa on top of the agenda. And I hope the one that will replace him today will be doing the same thing. He was a great president. Thank you.
Ladies and gentlemen, a big round of applause for this panel. We'll take some pictures before I ask our Vice President for Private Sector Development and Industrialization to give us some closing remarks. So if you can come on the stage, Kevin and
Okay, so I have the end job after you've listened to such great panelists, and I'll try to keep it short. The other thing that Hassatu mentioned is that at AFDB, for every challenge, we have a solution. So I'll try to weave some of those solutions together. But also, if I take into account what Papa said, which is we as development finance institutions should not really compete with each other. We should partner. In other words, 2 + 2 = 5. Even though some of these solutions are proposed by AFDB, they only come to fruition by really working in partnerships. Mr. Lepelec, did I get that right? Yes. Okay. You're constantly on the hot seat in Africa. When we look at you, we look at a high cost of capital. But I like really the points you made. It's important to have a presence. It's important to be transparent. But very importantly, you said we need the data. So when it comes to AFDB, we recognize that. We also realize that the investors who use the information are not going to change simply because, a credit rating agency is created in Africa. They are comfortable with S&P. As you said, they use this for their global investments, not just for the African investments, and they want to see really the benchmarks and the trade-offs. So the best that we can do is just make sure that you get the data. So this is where the gentleman sitting right next to you, our chief economist, we're going to be supporting really the statistics groups in countries. We're going to be, supporting the generation of that information. Yes, we would also want to create the capacity to challenge ratings. And so this is where we've been talking about a credit rating advisory agency that would really, one, provide the data, and also build the capacity to provide that quality data on a long-term basis. Because as you said, it's really historical statistics. It's not just statistics from last year. So that's where we hope to end up. Where's Admasu? I can't see him. Okay. I'm biased. Admasu is the best president of an African regional development finance institution. Yeah. And I can say that because I'm on his board. But what is most important, and I think this also feeds into a lot of our conversations, is Admasu is not comfortable with cozy. He's comfortable with challenge. And he did demonstrate it when he was talking about you have to create the right risk assets for the African institutional investors. I know the numbers are really nice. We talk about $2.1 trillion of assets under management from African pension funds, African insurance companies, African sovereign wealth funds. Yes, over 80% of that is invested in government treasuries, which primarily funds recurring expenses and not capital expenditures. However, if you don't create the right assets and if you don't have the appropriate regulation, that money is not going to, go into the trade fund. I mean, the trade, finance sector, and it's also not going to even go into the, into the infrastructure space as well. But I also know what keeps Admasu up at night. It's the ecosystem issues, as he put it, the regulation, the global financial architecture challenges, the treatment of trade finance in terms of debt restructuring. So at Admasu, the solution that we are offering is that we're going to work closely with AMFI. AMFI is the Alliance of African Multilateral Finance Agencies, which includes the likes of TDB, AfriExim, and the others. We'll be tough with you because Hasato is going to be part of the team, and Hasato and I will be tough. When you say PCS and it's not PCS, we'll be tough, but we'll also support where the global framework allows for that. So that's really what we're offering. My brother Papa, you said it all in terms of partnerships. I won't repeat that because I talked about it. But the other thing you mentioned is really this focus around domestic resource mobilization. It's both in terms of our capital markets work, where we can bring our pension funds and insurance pools. But the part that you've mentioned, which Professor Urama has been reinforcing in our minds, is that if we curb the illicit financial flows, there will be no need for aid. Yeah. I guess the statement I made. But I didn't get a rousing applause for that statement. Anyway, no, but Professor Urama has been talking about this for a long time. If we are able to really curb the illicit financial flows, that is a quantum far greater than what aid gives us. And this is the time, and this is where the developed countries, the non-regional countries, please, you have to partner with us, because a lot of the companies that are actually generating these illicit financial flows is really based on the tax arbitrage with our countries, and they are multinational companies. Let's be blunt about that. So thank you very much, Papa. And yes, you talked about the trend towards, the trend towards tied aid, but I also like Admasu's response, the 10 credit cards. We'll find a way to optimize. We'll find a way to optimize that. But the other point you made about the tied aid, which is also very important, is we shouldn't, from a procurement perspective, we shouldn't always look at the least cost option. We need to look at value for money. We also need to look at the life cycle costs, and that is where we're heading as development agencies, and we're sharing amongst ourselves. I know Heike very well, a German with humor, but okay. But that's where we're heading really as partners, overall. Okay, Heike, your football example was so apt. I hope I can use it. I will give you the intellectual property rights. I would always indicate that you provided it. But the message I picked up was it's an ecosystem approach. We all have to do what we need to do. Yes, we can reinforce each other sometimes, but we should stay in our lane. The commentator. Stay in your lane. However, since you're the one broadcasting on TV, we have no choice but to try to make sure your commentating is very good. But the other point, and this is something Heike and I keep talking about, is we want to maximize the number of goals. So we at AFDB are very supportive of EBRD entering sub-Saharan Africa. And the reason, and I keep emphasizing this to Heike, is that it shouldn't really be about market share, splitting the pie. It should be about growing the pie. And this is where we have to really work together, to get to that point. And, some of the last points I wanted to make, Forex risks. Hassatu said 27 years, but she only looks 30, so I don't know how she did that. But Hassatu is right. I mean, it's time to really crack the nut on the local currency issue. And this is really where we need to put our minds together as development institutions to see how we resolve that. But let me end by what I heard in all the parting shots. I heard innovation. I heard innovation. Is our group chief risk officer here? Dayo? Okay, I thought I saw Dayo in the back. Okay. It's about innovation, but it has to be smart innovation, and this is where we need to use our internal ecosystems, so that's why I was referring to our group chief risk officer. This is where we have to work across development institutions to be able to actually test out these innovations and then scale. There's something called the 4 S's. When I think of President Adesina and I think of innovation, no innovation would pass his own idea of an innovations lab unless it's what? Structured, systemic, scalable, and also sustainable. So I leave you on that note. Thank you very much. A very engaging session.